So we kind of, since last time we talked about how the increase in bond rates were starting to impact stocks. We had a correction for much of the month. We kind of had a normal correction and a bounce off of that, had some decent but not great indications of a demand response. We've got a bounce off of that, but we didn't get the kind of divergences that we normally get off the kind of correction that we had. So it's not really a, clear, all right, going to new highs. It's kind of a iffier situation. And what I would like to see is, again, we talked about last month, this HVN on the weekly chart being resistance for the NASDAQ. It's bounced off that, hit the first real level of weekly support, which is this sort of August highs, and has bounced back, and it's doing it just kind of questionably as to whether it's going to be something that can really go to new highs. And so we're kind of in this mode where we've increased our allocation slightly to net long things, but we're doing it cautiously, and we're still there. We're still kind of stuck in. You can't really allocate full bore. It still doesn't really look like a full cyclical rally because you don't have the decline in interest rates that you get before every other cyclical rally since really the 20s. So we don't have a lot of the components, but we're going with the relative strength and the trends that are happening. But you want to be ready to, on a moment's notice, pull the trigger and hedge your positions. And you also want to be ready for, if we start seeing better volume traction, better participation from small caps, some of these other things we need, then you can start adding more exposure. So kind of need to be watching for both situations and don't have a degree of certainty that we normally have in the backdrop. We're really not there. Kind of in a triangle here on the NASDAQ. You've got sort of this weekly HVN that we need to kind of close above and then show volume traction to really suggest that, okay, we got a while to go and we can start playing more aggressively on the upside. And then we really want to be watching interest rates for downside pressure and for continued downside pressure off this triangle resistance. So we talked about interest rates last month, and indeed, as soon as we broke out above these March highs, that's when the stocks started to take notice of the bond increase. And so we had a correction in the S&P until bonds peaked at really in a retest of their prior highs and backed off. That back off has allowed stocks to rally. The problem is that bond rates really have started up again. And so we really need to see the long bond fall below this 4% level and this uptrend line to have a better degree of certainty that bond interest rates are not going to be a problem. And conversely, we start testing, and even today, and Friday, we had a day where the market was mixed, not, with a little bit of an upward bias even, but bond rates really went up and bonds really fell. Today, they've continued to fall, and now that's pulling stocks lower again. So we're in this area where we really need interest rates to drop below 4% to have any degree of certainty about the durability of the rally. And if we continue to move higher in rates, which if you look at plurality and some of the other things that Chuck's talked about and we've talked about, there's a real risk that we break out to new highs. We break out above these 433, 440 area and close above that in the TNX, the long 10-year bond yield. That's likely to be a much bigger problem for equities and at least create another leg down in the correction. So it really, this is a big deal. Kind of be watching 395 level and lower, thumbs up for stocks, unless it's accompanied really negative economic news that's hurting stocks. And if bond rates continue to move higher, we're starting to get into trouble for stocks. So it's really a situation where we have to watch a lot of things and be cautious and be ready to pull the trigger either way. The market still futures market is still discounting somewhere between the March 20 FOMC meeting and the May 1st FOMC meeting in 2024 when rate cuts start. That's a much different scenario than the FOMC members on the Fed. The Fed members, there are a couple that expect there could be, possibly one rate cut late in 2024, but every other member, no rate cuts at all in 2024. That's a big difference in scenarios. And one of the things that this is really getting to be important, we want to understand that most of the Fed studies and any kind of studies that show how an interest rate hiking cycle works is really it doesn't begin to bite substantially until we get above the inflation rate on the interest rate. Really haven't had that for very long. And really the last 3 or 4 rate hikes are toying with that area. But once we get that, there can be 6 to 12-month lags as it continually hits the economy. So we're looking at something that could still hit the economy substantially. We still have the inverted yield curve that every time it's been inverted within 18 months, we've gotten a recession. We still have leading economic indicators that are also indicating recession. So we really have to be careful. Markets kind of celebrated a little bit the decline in a lot of economic PMIs really globally last week. And that's right, that does fit in with the soft landing scenario, but you want to be careful that that doesn't continue and start to unravel more, because it's a Goldilocks scenario that the market is clinging to. And if you start to get weakness that concerns people that, oh, maybe this is not soft landing, maybe there's possibility of hard landing is at least increasing. Now you're going to get shifts in the market. You're going to start to get some selling, and you're going to get some pressure on the market. So we really have to watch 2 things in particular. We have to watch the market is expecting inflation to drop to that Fed target level somewhere around February. And in the last report we talked about, there's comparison numbers that make it difficult, and inflation did tick up, CPI, PCE, and the one that the Fed has talked about that it's really watching, which is supercore inflation. Supercore inflation ticked up hugely. It ticked up from like 3.3 to 3.9. So inflation's starting to tick up because of those comparison numbers. And then as we talked about, and as we'll see, the component of the inflation indexes that had the most to do with year-over-year inflation declining this year has been that big decline in crude oil from June 2022 to June 2023, where it dropped almost 50%. But since then, it's up 27%. And as we'll see, it's broken out of a 9-month trading range and is projecting substantially higher prices. So now we've got some real problems with that inflation dropping by February to the Fed target scenario. And just realize the only time inflation ever fell that fast from as high as it's been for as long as it's been was post-World War I. And as we talked about last time, post-World War I had huge cuts in spending. The cuts in spending were like 50% in spending. We haven't had anything close to that kind of cuts in spending. In fact, the deficit is still between 8 and 9% of GDP, which is insane in an environment where unemployment is so low. So that also puts pressure on inflation. It keeps aggregate demand high, and it really makes it hard for it to fall to that Fed target. So we've got a kind of a balancing act, and you can stay on that high wire for a while, but you got to watch both sides. You got to watch if inflation is starting to not drop enough for this expectation of cutting rates by March to May. If that starts to erode, or if interest rates start to pick up, the TNX starts to rise, rates again, that's going to be tough on the market. Or if we start to get softening in the economy more than we've seen, enough that people are starting to worry about the downside, that's also, it might be good for bonds, it's not going to be good for stocks.